Bloomberg Audio Studios. Podcasts, radio, news.
I'm pleased to say that joining us now is the former St. Louis Fed President Jim Bullard. Jim, welcome back to the program, sir. It's been a while. We haven't spoken to you, I believe, since Chairman Powell spoke in the news conference, so we've got to ask you. We need your reaction. The T word making a comeback at the Federal Reserve. What did you make of that?
It's not making a comeback with me. I'm not using that word. I think that I do think that the committee has, good reason to stick with the policy rate where it is. Inflation expectations for the next 2 years in the TIPS market have been rising. They're about 3.25 today. That's a CPI-based measure, but if you put that over to a PCE-based measure, it'd be around 3% PCE inflation over the next 2 years. That's what the market is thinking. That's too high for the committee. The committee's trying to get, especially core PCE inflation, which came in a little bit hot here. You're trying to get core PCE inflation down to 2%. So they're going to have to be higher for longer. And if it goes too much farther, they're going to have to raise the policy rate.
Wait, hold on a second. Because, Jim, this is exactly what people thought that Fed Chair Powell did last week when he said transitory, the word that you will not go so far as to say, is that he would be willing on some level to look past tariff-related boosts to inflation in the short term, especially if growth was sagging, and that the Fed would have to or be open to responding to slowing growth. Are you saying that inflation, should it be above expectations because of tariffs or whatever else, it's going to be important to address?
The committee should be hitting their inflation target 2 years from now. And what the market is saying is, no, you're not going to hit it. You're going to hit 3%. That was my story here. So that doesn't sound very good to the committee. Now, maybe the market's wrong. They often have, and I'm talking about 2-year tips here, and they can move around, yes. But it's a good reason for the committee to stay where it is. I have argued that the committee's in good shape here. They didn't go as far as was previously expected on cutting the policy rate. So they stayed a little bit higher. I think that's turning out to be wise. The tariffs, when I say tariffs don't cause inflation, what I mean is that inflation's a product of monetary policy over the medium term. And it's not up to the trade representative to control inflation. It's up to the policymakers to control inflation. And they have to adjust policy appropriately, given everything else that's going on in the economy. And so, and over a 2-year horizon, that's something you should be able to influence. But right now, markets are saying the committee doesn't look tight enough to get down to 2% at the end of 2 years.
Jim, do you think that the Fed should open the possibility of hiking rates again?
Well, it's not my base case, but I think the probability on that is rising slightly here. And this wasn't that radical of a data release here, but I do think that possibility is rising. We really haven't made any progress on getting core PCE inflation down, let's say over the last year. I think the man on the street would look at those numbers and say, no, it's basically been flat for the last year.
Jim, one thing we've heard repeatedly from some economists is this labour market's just not as tight as it was. And because it's not, that dampens down the potential for second-round effects from the inflationary kick-up that you get from tariffs. What would you say back to that? How fertile do you think this environment is for second-round effects?
I don't know. Come on. Unemployment insurance claims, ridiculously low. That's your best week-to-week indicator. Unemployment rates, if anything, is probably below the natural rate for the U.S. economy, but certainly low by historical standards. I just don't see it right now. Now, there's fear of the future and what might happen, and we know that the last tariff war in 2018, 2019 did cause a slowdown in the economy, and that the Fed did react to that by lowering the policy rate. So we'll see if that history repeats itself here. So that it's the expectation that people might be thinking about. But as far as where the labor market is right now and whether that's disinflationary pressure coming from there, I don't think so.
Jim, can we have a best guess from you? Next move, cut or hike? What would your best guess be right now?
I still think the committee can stick to its baseline that there will be further cuts, but they're being pushed farther and farther out into the future. And now with a hotter core PCE year-over-year number, you might start pushing those out into 2026 instead of 2025. We'll see what the market does in the days ahead.
Hey, Jim, before you go, Boilermakers play tonight, don't they? Sweet 16?
Yes. And
you feeling good about that?
The victory for the Boilers here. We're playing in Indianapolis. I think they don't lose at home very often, so I think they've got a good shot.
Boiler up. I do that because you know the manager who does my reviews, Purdue. Appreciate it. Thank you, sir. Former St. Louis Fed President Jim Bullard.